Oil prices are surging as the U.S.-Israel war with Iran intensifies. The Federal Reserve just paused on raising interest rates. Could your wallet feel the impact next? The Federal Reserve has voted to hold interest rates steady once more. This decision comes as oil prices spike sharply following the start of the U.S.-Israel conflict with Iran. The Fed is navigating rising economic uncertainty and the threat that inflation could climb higher due to these energy price shocks. Officials are widely expected to maintain this position at their current policy meeting, aiming to contain price spikes while assessing the war's ongoing impact. The war's economic fallout has prompted the OECD and the U.S. Federal Reserve to increase inflation projections for this year. The OECD now forecasts inflation at 4.2% for the U.S., which is 1.2 percentage points higher than previous estimates. This jump highlights how conflict-driven oil price spikes can ripple through the economy, pushing consumer prices up and complicating the Fed's monetary policy decisions. Investors have reacted to the inflation threat by driving interest rates higher, which in turn has put pressure on stock prices globally. The fear is that persistent inflation will stop central banks, including the Fed, from cutting short-term interest rates anytime soon. This market response underscores the delicate balance policymakers face between controlling inflation and supporting economic growth amid geopolitical tensions. Within the Federal Open Market Committee, hawkish members like Kevin Warsh hold significant sway despite being only one vote among 12. Warsh's track record favors reducing the Fed's bloated balance sheet and resisting rate cuts. His stance signals that some officials prioritize fighting inflation aggressively, even as geopolitical risks complicate the economic outlook. Looking ahead, Federal Reserve officials will focus on containing price spikes caused by the ongoing war. While interest rates are expected to remain steady in the near term, the situation remains fluid. Any escalation in conflict or further oil price increases could force the Fed to reconsider its stance, potentially impacting borrowing costs and economic stability. What this means for you is clear. Higher inflation could affect everyday prices from gas to groceries. The Fed's cautious approach means borrowing costs might stay elevated longer, impacting loans and mortgages. Stay informed, plan your budget carefully, and subscribe for daily updates on how these global events could hit your wallet.